This is BD Daily Finance News Podcast, daily insights on markets, economy, and investing. It's 2025, December 13th, and today's theme is simple. When rates, politics, and AI hype collide, markets get allergic to uncertainty.
I love how markets are like, we're rational, and then one rumor walks in and everybody flips the table. Today feels like yields up, stocks down, and AI vibes emotionally complicated.
We'll cover three big stories: Fed chair succession chatter and why it matters, the global problem of elevated long-term bond yields, and renewed AI angst tied to Oracle and OpenAI infrastructure timing.
And we'll translate it into normal people decisions, like should I refinance, should I buy the dip, or should I simply stop checking my portfolio like it's a toxic ex?
Story 1. Fed leadership politics. One headline says, President Trump said Kevin Warsh is at the top of his list for the next Fed chair, and also suggested the president should be consulted on rates.
The market hears, your inflation-fighting referee might get heckled from the stands, and investors are like, cool, love that for my bond portfolio.
The finance behind it is credibility. Central bank independence is basically the market's belief that the Fed will make unpopular decisions, like keeping rates high, if inflation demands it.
It's like letting your kid consult on bedtime. You can consult all you want, but if the kid gets a vote, bedtime becomes a suggestion and everyone's cranky tomorrow.
Why it matters. If investors suspect political pressure could push rates lower than inflation warrants, they demand a higher yield to hold long-term treasuries. That raises borrowing costs across mortgages, auto loans, and business investment.
So even if you never buy a bond in your life, the bond market still shows up like an uninvited guest and changes the price of your entire existence.
Story 2. A broader piece on how debt, inflation, and politics are driving up borrowing costs globally. The idea is that elevated long-term yields aren't just a one-week tantrum. They can be a regime.
A regime sounds fancy, but what it means is your 30-year mortgage rate might stop acting like a yo-yo and start acting like a stepladder, upward.
The simple version, lenders want compensation for two risks: future inflation and fiscal uncertainty. When deficits are large, the market may demand a bigger term premium, meaning extra yield for tying up money for longer.
Term premium is basically a security deposit. You're lending money to a roommate for 10 years, and you're like, I need extra because I've seen how you live.
And when politics raises questions about central bank independence, that can feed the same premium. Investors start pricing not just inflation, but the risk that inflation will be tolerated.
So the market isn't being dramatic. It's doing math. Annoying math, but still math.
Actionable takeaway: if long-term yields stay high, duration risk stays real. For everyday investors, that means don't assume long bond funds are safe just because they're bonds. Price can swing when yields move.
Bonds can absolutely hurt your feelings. If you bought a long-duration fund thinking it's a warm blanket, surprise, it's a weighted blanket, and it's on your neck.
Story 3. AI exuberance is getting a reality check. One report suggested Oracle would complete data centers for OpenAI in 2028 rather than 2027, and Oracle responded saying there have been no delays in the arrangement after the stock slid.
Nothing says confidence like a company announcing, we are not late. That's what I text when I'm already late.
The finance behind it: markets are pricing AI like a CapEx supercycle, massive spending on chips, power, cooling, and cloud capacity. If timelines slip, even by a year, it can compress revenue expectations and multiples across the AI supply chain.
It's basically like pre-ordering a game console. If delivery moves from next year to the year after, you don't just get annoyed, you start questioning the whole hype cycle.
We also saw a market wrap that said U.S. stocks fell with renewed AI angst, citing things like an AI profit warning from Broadcom and hawkish commentary from Fed officials. The common thread is valuation sensitivity when rates and growth assumptions wobble.
So AI stocks are like, when it's sunny, they're a sports car. When rates pop and guidance gets weird, they become a shopping cart with one bad wheel.
Why it matters for normal people. AI CapEx influences jobs, wages, and prices, especially in tech hubs and industrial supply chains. But for your portfolio, the key is concentration risk. Many index funds are heavily exposed to a handful of mega-cap AI-linked names.
If your retirement account is basically AI and vibes, today is your reminder to check what you actually own. Diversification is not a personality trait. It's a plan.
Quick playbook recap. 1. Watch long-term yields, not just the Fed's next meeting. Mortgages and corporate borrowing price off the long end. 2. Treat AI infrastructure headlines as leading indicators for sentiment, not gospel for quarterly earnings.
3. If you're making a money move, make a small one, like rebalancing, raising your emergency fund, or checking your bond duration, rather than panic selling because a data center might be finished in the year that ends in 8.
And if you want one mental model, when credibility gets questioned, the price of money rises. That shows up as higher yields, lower valuations, and more volatility, especially in long-duration assets like growth stocks.
So today's vibe is don't fight the bond market, don't marry a narrative, and don't let your portfolio be a single genre playlist.
That's it for today's BD Daily Finance News podcast. If this helped, subscribe and leave a comment with the one indicator you're tracking next week: yields, inflation data, or AI CapEx headlines.
And share this with a friend who says, I don't follow macro, while macro follows them into their mortgage payment. See you next episode.